Monday, the 30th of October, 2023. Good morning. Back to the future. Will there ever be an end to this economic gloom? Right now, it feels as if global stock markets will never see recovery again. The geopolitical landscape is frankly a basket case, with Middle Eastern tensions flaring at exactly the same time as a Cold War has reignited between communist and democratic states. You would be forgiven for buying up all the beans and toilet rolls in Tesco and hiding under your bed. Since the end of 2021, all investment portfolios have really experienced similar challenges, as bond markets crashed simultaneously to equity markets. You can take your pick as to the contributors to this: pandemic, supply chains, Russia's invasion of Ukraine, politicians, migration, central banks, China-America trade wars. Frankly, the list is exhausting. The net effect of the past few years' challenges, other than my few grey hairs, has been that the bond markets are utterly on their knees. This is really bad for more cautious portfolios and for the entire financial system. Bonds, such as UK gilts and US Treasuries, need interest rates to stay consistent or even fall. Nobody really expected a scenario where central banks would crank up interest rates at such a terrifying speed that they virtually broke the very system they're entrusted to protect. In sympathy with this, global equities, really with the exception of oil and arms stocks, have also crashed downwards. The recent developments in Israel are now putting more upward pressure on oil again, as well as putting downward pressure on equities. It's like one big perma-crisis, and it's never happened before, right? Well, actually, it kind of has. In 1969, the global economy was on the back of a boom period, and it was running out of steam fast. Cold War escalation between the Soviet Union and the West, coupled with a terrifying Middle Eastern conflict, all pushed oil prices through the roof. This meant that central banks, such as the Fed, had to deal with rampant inflation. Faced with the prospect of an overheated inflation bubble, they cranked up the interest rates hard. The knock-on effect of this was virtually identical to today. Bond markets crashed down, and the US S&P 500 equity index lost 34% from 1969 to the end of 1970 as the US plunged into recession. Here's the eerily similar bit though. This recession was so well telegraphed that the markets fell way in advance of the actual recession. So, as the US went into recession at the end of 1969, the S&P 500 had already lost 20% from its peak. Today, the S&P 500 is sitting around 20% down from its peak. I've attended several webinars and seminars over the past month, as well as exchanging multiple phone calls with our fund house contacts, and every single one of them says the same: recession is coming. They fully expect to see the US enter recession in the early part of 2024, with Europe and the UK following shortly after. So what happened once recession commenced in 1969? Well, inflation softened considerably, although it still sat under the surface. The Fed started to loosen monetary policy again to try and reboot the US economy, and by dropping rates again, and the bond market returned to normality. The S&P 500 in 1969 did continue to lose ground, and unemployment more than doubled in the US over that year. This completed the S&P 500 crash down to 34% from its peak. However, within a year, the recession had ended as rates and inflation normalized. By late 1970, the US economy was bouncing back, and the S&P 500 then experienced a, wait for it, 73.5% gain over the next few years. Now, whilst past events don't always repeat themselves, the incredible similarities between 1969 and 2023 should not be overlooked. Of course, central banks might behave differently this time, creating a less favourable bounce, or a unique set of circumstances could mean that we're already at the bottom of this crash. My point is that history is jam-packed with instances where the investors of the day faced incredible challenges and often a plethora of negative economic headwinds. However, the winners were always those who held their nerve, remembered the long-term game, and took heart from previous instances where crashes turned into recovery. Now, this has been a long one, folks, and in total honesty, I think it's now likely to get a bit tougher before it gets better. But I am very encouraged by the underlying fundamentals of many stocks within your portfolios now. They're priced incredibly cheaply, and this will eventually lead to very pleasing returns. For now, it's a game of patience. I really appreciate how worrying the world is currently. It's at times like these I find myself incredibly thankful to be living where we do. There are many things I count my blessings for, such as my faith, family, and friends. And recent events do create some healthy perspective. However, if you are at all worried about your portfolio or financial plan, don't be a stranger. Call us. We're here for you all the way. And history teaches us that we will celebrate better years together in due course. Of this, I am certain. My very best wishes as ever, and I'll be in touch for our quarterly review in about a month's time.